the group financial statement, which is actually the section D of the syllabus. This is to actually be in line with what my other colleagues actually done. In the last class, she was able to actually discuss extensively on some revenue recognition, as well as some tips that is required for the SBR success. So today, we shall continue from there. We are really looking at the section D aspect of the syllabus, which is actually the financial statement of an organization. Okay, when we say financial statement of a group entity, this actually tells us the various way by which an entity actually consolidates. How we are going to be examining the various relationships that really exist between an organization, between one entity and the other, and also to know when the entity is actually able to consolidate and when the entity cannot really what? Consolidate. It should be worthy of note that to know that before business combination can actually occur, there are some certain criteria that actually needs to be what? Examining. Today, we shall be examining some group financial statements, some financial statements of a group entity. When we say financial statement of group entity, we are to actually look the basic group structure that we have or that exists within an organization. Various structure that exist within an organization. And we also need to look at some standards that also guides the preparation of a financial statement of group entity. These are what we shall be examining during the course of our lecture. So my dear all, let's get started. When we talk about consolidation, it is financial statements of group entities. So it is worthy of note that the various consolidation procedure that we have is, let's first of all talk about the various investments that we have. We actually have what we call simple or ordinary investment. When we say simple or ordinary investment, this is actually an investment between 1% to what? 19%. Any investment that is between 1 to 19% is virtually regarded as simple investment. And simple investment can also be called ordinary investment, which is just the investment that an entity is having with another entity, which is the investment that one is having in another entity. And when we are talking about the simple investment, the various standard that we'll be looking here will be our financial instrument. May I ask that what are the standards that actually guides financial instrument? What are the standards under the financial instrument? Any idea? Kinsley? Kinsley, are you there? When we talk of financial instrument, what are the standards that we have under financial instrument?
IFRS 9.
We have IFRS 9. Okay, you can do better.
IAS 32.
We have IFRS 9. IFRS 9 is what? IFRS 9 is what?
The presentation.
You can do better.
Financial instrument presentation.
Financial instrument presentation. Yes. Is it presentation? Is it presentation?
Not 100% sure of that. Let me check.
What are you checking?
I can't remember that.
You cannot remember. Okay, that is fine. When we actually talk of financial instrument, then there are many standards that we have there, in which one of it is actually our IFRS 9. And IFRS 9 is financial instrument recognition and measurement. That is what we have under our words, IFRS 9. If IFRS 9 is recognition and measurement, which other one do we have?
IAS 39.
IAS 39 has been replaced by IFRS 7, yes or no? IAS 39 is what is replaced by IFRS 9.
Okay.
You can do better. Which other standard do we have there? What about IFRS 7? IFRS 7 look at what?
Disclosures.
Disclosure of financial instrument, disclosures. Then, it's also remain one.
32.
Can you tell me that? IAS 32. And IAS 32 talks on what?
Presentation.
Financial instrument presentation. So, this financial instrument is always called simple investment. This is what we call simple investment, or we call it ordinary investment. And part of the ordinary investment, the one that actually we have IAS 32, which talks about the presentation. We have IFRS 7, which actually talks on the disclosure. And we also have IFRS 9, which actually talks about the recognition and the measurement. May I ask, how do we really recognize and measure financial instruments? From here, according to IFRS 9, as per the IFRS 9, IFRS 9 says that financial instrument is actually any contract which give rise to both a financial asset in an entity, is going to give rise to the financial asset of one entity, and we create a financial liability in another entity. That's a financial liability or equity. In what? Another entity. I haven't said that When we say financial assets, what do we really mean? Financial asset is, we said that financial instrument is going to give rise to either financial assets or create a financial liability. If it is not financial liability, it's going to measure an equity in the other entity. So when we talk of financial assets, we are actually referring to any cash or any contractual rights to receive any cash or what? Equity. To receive any cash or what? Equity. Okay. As a result, here we'll be having, let's have our shares. Then we have receivables. We have loan notes. Okay. Prepayment is not part of financial assets. It is just a contractual right that is pertaining to non-financial assets. And for financial liability, it can also be a share. It can be loan. Let's say loan notes, etc. So how do we now measure our financial assets? Our financial asset is either, if it is an equity instrument, we have to recognize whether it is an equity instrument. Yes, that might. Let me. Okay. Let me have these two here. So for the financial asset, it's either it is an equity instrument or it is a debt instrument. Sorry, please, can you see my board?
Yes, I can.
So if it is an equity instrument, then we are going to measure either through fair value through P or L, or we measure fair value through OCI. If it is fair value through profit or loss, that is, for the initial, we have for initial, that is, if it is initial recognition, just like this, yes. Initial recognition, we are going to measure the fair value based on the valuation, and the transaction cost, we are going to expense. For the valuation, we are going to use fair value, and for transaction cost, we expense. We expense. Then, for our subsequent measurement.
Sorry, please, I have a question.
Okay, bring it on.
Okay, you said valuation at fair value.
Yes.
Okay. Then you said
Yeah.
transaction cost expensed.
Yes.
Okay. Valuation, are you talking about the basis at which we measure or where to be recognized? In what part that to be recognized?
We are actually talking about the recognition. How do we recognize equity instrument? It's either we classify it as fair value through P or L or fair value through OCI. At initial, that is, as at the beginning, as at the point of making the equity instrument, the actual value shall be at fair value basis, fair value measurement. And every other cost, incidental cost, we are going to expense that.
Okay.
But the actual value will be at the what? Fair value. I hope that is taken.
Yeah.
Also, for subsequent measurements, the valuation will be at the fair value and for any changes in the cost goes to our what? P and L account. It goes to our what? P or L account. If let's say that if the equity instrument is rising, the changes therein goes to our what? P or L account. While we will still value it at the initial cost of that asset, of that instrument rather. Where we are still going to value it at the initial cost of the what? Instrument. Having said that, for the fair value through OCI, at initial, okay, at the initial of fair value through OCI, the valuation is also going to be the fair value plus any transaction cost. Transaction costs are incidental costs. To buy equity, to buy financial instruments of which bank is actually selling their instrument now. The fair value would be the original cost of the instrument. Then any other costs, if it is going to P or L, you will expense it. If it is going to OCI, that will be added to the what? Amount. It will be the total cost that we paid towards the acquisition of the instrument. Okay. Then, like we said, we have valuation as fair value. Okay, sorry, let me break it down. Let me break it down like the first one so that at initial, we have valuation. We said valuation will be the fair value plus any transaction cost. And the transaction cost we have already capitalized that as above. Okay, so for subsequent, so for the subsequent measurement, the valuation will be the fair value. Then any changes that occur in the instrument, that will go to our what? OCI. That's for the subsequent measurement. That is for the subsequent measurement. And these are equity instruments. For the debt instrument, it's either we have our debt instrument, will be classified into fair value through P or L account, okay, or we classify it as amortized cost. Let's call it amortized, or fair value through OCI. Fair value OCI. For the debt instrument, initial valuation will be the fair value, and the transaction cost we are going to expense. While the subsequent, we have the valuation as the fair value, and any changes therein, it goes to profit and loss. If there's any finance income, that's going to be at our what? Coupon rate. Then at amortized, we will have our initial. Our initial at amortized will be fair value plus the transaction cost, and the transaction cost will have been capitalized as above. In which the subsequent will give us our cash flow value as per the amortized cost, and then there's no need for the changes therein, and any finance income will be the effective rate. And our OCI will be valued at fair value, while any changes go to OCI, and finance income will be the what? Effective rate. This, when we actually get to financial instruments, we shall actually be discussing it in details. Another form of investment that we have is what is known as what? Associate. An associate is an investment between 20% to 49%. Are we still together?
Yeah.
So when we talk of associate, an associate is where an entity has a significant influence over the associated company. And the significant influence that we mention here is actually the power to participate in the financial and the operating policy of the organization. In this case, it should be between 20 to 49%. Okay, so let's write significant influence. Okay, and for the significant influence for the associate, we actually use IAS 28, IFRS 3, and the likes. But it is basically IAS 28 that really covers extensively. And IAS 28 only permits equity method of accounting when you are accounting for investment in associates. Do we get that?
Yeah.
Another one that's okay, before we move out from the investment in associate, let's quickly look at other situations where significant influence actually exists. So we can say that there's a situation So when we have a representation or anyone that hold investment in associates can actually represent on the board level. We call it representation on the what? On the board. Then to have the ability to participate in policy making. So also, it will also have material transaction. There can exist material transaction between the two parties. Okay, then every other one is also there. Influence is where another entity actually have direct, it does not hold the control. However, it can only impact or affect the decision making of an organization. It can impact and affect the decision making of an organization. Take note of that. The other one is where we have 50% by 50%. That's really called joint arrangement. That is called joint arrangement. A joint arrangement is actually where two people agree to come together to pivot a business towards the same aim. The aim of doing business together is enormous. However, for a joint arrangement, it can actually have some expiration period. It is far different from that of consolidation. No, it's far different from that. Having said that, the next one that we also have to look at is investment above 50%. Let's say 51% and above. For investment that are 51% and above, we can call that parent and subsidiary. Parent and what? Subsidiary. Who is a subsidiary? Are you there?
Yeah, I'm here.
Who is a subsidiary?
A subsidiary is I would say a subsidiary is a firm that's owned by a parent.
Yes. Not just owned. It's also controlled by another entity.
Yeah.
Known as parent. Okay. An entity that is controlled by another entity is actually known as parent and subsidiary. It's actually known as parent and subsidiary. Before we now talk on the subsidiary in details, How do we know that business combination actually occur? And is a transaction actually a business combination? The answer is no, because in actually answering the ACCA question, we need to understand the root. According to IFRS 3, what is IFRS 3?
Business combination.
Yes. Provides guidelines as follows. Let's provide guideline for business combination. It says that it can be let's say one. It can actually be either by giving cash, it can be by taking on liability, or issuing shares. If all this do not occur, everything that we've done is all on contract, not a business combination. For me to say that I am combining a business with another one, I must have been given by cash, take on liability, or issue share. And there would also be a structure in which the structure will be either, let me say, can be an entity becoming subsidiary of another. Okay? Or an entity has actually transferred okay. The third one is there must be an acquisition of a business. Where there's no acquisition, we cannot say that there's a business combination. If all this exists, then we can say that yes, there's actually a business combination. And a business can actually be an input, it can be a process, it can also be what? An output. Okay, now let's continue. Sorry, can you hear me?
Yes, I can hear you.
Okay. So I haven't said that. So let us quickly go to our subsidiary. First, to know that a subsidiary actually exists. We said a subsidiary is actually an entity that is controlled by another entity. Another entity which is known as what? As parent. Okay. And the term is what? Control. How do we really know there's a control? The control actually exists where there's a power to actually direct. I said parent-subsidiary relationship actually exists when the parent hold more than one half of the voting rights of what? An entity. Where a company is holding one half of the voting rights of another entity, then we say that control actually what? Exists. Then the parent has more than one half of the voting right by virtue of agreement. Yes, at times the parent may not necessarily hold one half, but it may be the combination of other shares that is going to result to that one half. Either way, so far it is one half, it can be termed as a parent company. So far it is one half, it can be termed as a parent company. So also, when the parent has the power to govern the financial and the operating policy of another entity, then we know that that entity that is governing is actually its subsidiary. For example, look at the children and their parents. Children cannot do things without their parents actually what? Controlling them until they are matured. Where there's that is parent-subsidiary relationship. Then where the parent company actually has the power to appoint or remove majority of the board of directors, then we can say there exists a parent company. Then note that the underlying principle the underlying principles of consolidation are actually what? One, we have what we call substance over form. Do you remember substance over form? This was still discussed last week. This was still discussed in the last class.
I wasn't in the last class.
Okay. Also, where there is a control and ownership. So what do we understand by substance over legal form? Any try?
No, no idea.
I try. When we say substance over legal form, It means when a financial transaction are actually reported based on the economic reality as against the legal reality. Okay? Economic reality as against its legal appearance. So when we report a financial transaction based on the economic reality and commercial substance, when we say economic reality, it means how the transactions actually occur, so that it can really show the truth and fairness view of the financial statement, and that it will not mislead the presentation of the financial statement. For example, if you look at hire purchase agreement, the legal form actually says that a company will buy, let's use a car, on a hire purchase basis and has already paid the advance, then agree to pay the remaining balance by installment. Legally, the company actually do not own the right until the final payment is made. But the economic reality is that control has been passed to the person. So since the company control the asset and the benefits from its use for the entire duration, then it can actually recognize the assets in its SOFP, and we even depreciate it over the useful life. And all the payments, all the remaining payments will be treated as a liability reduction. But the legal form says no. It does not have the right until you make a final payment. So that is substance, means the importance over what the rule says. Rule is legal form. How that is taken.
Yeah.
So another one is actually control and ownership. Control and ownership means for us to consolidate, there must be ownership of a firm. Somebody must be controlling it, which is known as parent company. Somebody must be controlling it, which is known as parent company. Take note of that. How do we now consolidate? Basically, in consolidation, we have discussed about the various standards that we have there. So to actually consolidate, there are some rules that we actually have to follow. For an entity to consolidate, one, they must have a uniform accounting policy, which I call same accounting policy. Both the parent and the subsidiary must have the same accounting policy. I can say to consolidate, consolidation is to consolidate. Consolidation is when the account of subsidiary and that of the parent company are prepared as though they are for a single entity. So to consolidate, the two companies must have same reporting period. Okay? The two companies must have the same accounting period. One cannot be using August and another one will be using January. It doesn't jive. Both of them have to use the same accounting policy. So they must use the same accounting policy. Okay, sorry, not accounting period. Same accounting policies. So the same accounting policy means one cannot be using accrual and the other one will be using cash. It must be the same thing. Yes, they must also have a uniform accounting period, just as I've written earlier. Okay, and the most important thing, are we together? Hello?
Yeah, I can hear you.
Okay. I lost the voice. Can you hear me? What's happening?
Yes, I can hear you. I'm muted, that's why. Hello? Hello? Hello?
Hello, sorry, can you hear me?
Yes, yes.
Okay. So I said they must have same reporting policy and also have the same, which I call uniform reporting period. Those are the two key main things. The reporting date must be the same. The accounting policy must also what? Be the same. And all subsidiaries have to be what? Consolidated, unless they do not meet the criteria for what? Consolidation. As a matter of such, for a company not to consolidate, which we call exemption to consolidation, the various exemptions for consolidation that we have is what are actually termed as what? UMIDIST. When we say UMIDIST, it's an acronym that I've used. UMIDIST, H means harmful, U means unnecessary expense, M means misleading, I is insignificant, DIF stand for different activities, Second I stand for impracticable, S for severe restriction, T stand for temporal holdings. So now, let's quickly explain this acronym. Not all situation, a company that owns another company can consolidate. A situation where they do not meet the criteria to consolidate, they are not going to consolidate, they are going to prepare separate financial statement. So where a company cannot consolidate, is going to prepare a what? Separate financial statement. Separate financial statement is which standard? That's our IAS 27. Okay, that's our IAS 27. When we say harmful, where the parent company sees that consolidating the activities of the subsidiary will be harmful to the users of the financial statement or will cause more harm to the organization. Instead, it is allowed not to prepare a consolidated financial statement, but must disclose it. Where it says that it will result to some unnecessary expense, a high cost for the company, which does not meet the rent test, then it's also exempted. Where it says that the activities of the subsidiary will be misleading the users of the financial information, then do not consolidate. Where you see that it is really not necessary to consolidate, as a result of a reason or the other, you are exempted. Where there are different activities that they are doing, one is in the financial sector, another one is in the hospitality firm, they cannot consolidate too. Impracticable, where the parent company sees that it is not possible to prepare a consolidation, they are exempted. Where any of the company are having some restriction in their activities, you cannot consolidate. Where such acquisition is not a permanent one, where it is put under your care, where you are just to supervise, where you do not have the direct control or ownership of the other company, it is called temporal holding, you are exempted from consolidation. Any question on this?
No.
Okay. So what are the things that you always acquire? It is assets and liabilities. Let's go to acquired assets. And what? Liabilities. According to IFRS 3, we have to recognize the principle, which include, we have what we call the recognition principle and measurement principle. Let me write it down for you. Recognition. Everything is actually in the notes. It shall be shared after the class. Sorry, please. So for recognition principle, it means that we have our identifiable assets acquired, liabilities is assumed, and also we recognize goodwill and the interest separately. Why for measurement principle? This, all assets acquired and liability assumed are measured at acquisition date at fair value. All the assets and liabilities are expected to be at its fair value. Take note of that. Having said that, let's go to the various types of consideration that we have. Let's go to various types of considerations that we have. Let's go to the various types of consideration that we have. Basically, by the nature of ACCA exam, types of consideration, which is known as cost of investment, are actually categorized into three. Acquire, subsidiary, company. It can be divided into majorly three. It's either by cash, it's either by share exchange, or by deferring the consideration. Or by deferring the word consideration. It's either by cash, by share exchange, or by deferring the consideration, which we call deferred consideration. When we talk of cash, cash is actually, okay, let me add contingent. Contingent consideration. It should be worthy of note that cash consideration majorly can be at present value, let me call it now, if you pay prompt. Okay. It can also be deferred. Then it can be, if it is deferred is measured at present value. Then if it's not deferred, it will be contingent. And contingent is measured at fair value. Okay, now, which is the cash we are paying prompt on account? Let's say it's at price paid. Price paid, or we use the share to calculate the price that is paid. And for the share exchange, the share exchange is measured at the fair value. Okay, on the date the parent company actually buys the share of subsidiary company. Let us take note of that. And here also, when we talk of transaction costs, we are actually referring to all the incidental costs, such as some legal fee, such as some legal fee, and legal fee must be expensed in the what P&L account. We do not capitalize them. So please don't capitalize any transactional costs that occurred in the what acquisition of one company and the other. Having said that, when we say consideration by cash, this occur where the parent company purchase another company and it decide to pay by cash, that is paid on account. Another one is a share exchange, where the parent company offer a proportionate of his share in exchange.
I can't hear you well.
I'm breaking. Can you hear me now? Is it clear now? What's going on? Is it fine now? Elegantly? Okay.
Yeah. Yes.
So, can you hear me now?
Yes.
So when we talk of transaction cost, there are actually some legal fee that we have to expense in the what P&L account. Having said that, let's quickly look at, we have talked about the types of consideration. Okay. Before we actually consolidate, ideally, we are not going to be doing much of consolidation, but there's a need for us to really understand the cardinal rules of consolidation and how it actually come to play. We have explained subsidiary. There's what we call a group structure, which is actually the percentage of parents in the other entity. From this diagram, it can be evidence that a parent company acquires subsidiary company and also acquire another entity known as what? Associate. It may occur where the parent would acquire more than one entity. And it may occur that it will just be one entity that he was acquired. Please take note of that. Please take note of that. Having said that, to calculate the cost of control, it must be subsidiaries share that is acquired by the parent company divided by the total shares of subsidiary multiplied by 100/1. That is going to give us cost of control. And when we say cost of control, we mean the percentage that the parent company acquired in subsidiary company. The percentage of acquisition of parent company in subsidiary, that is simply what we call COC. The second one is adjusted retained earning. The second one is adjusted retained earnings. In order for us to really get the retained earnings of the subsidiary, which we call the post-acquisition profit, there's a need for us to adjust the retained earnings of the subsidiary. We first of all pick the retained earnings of the subsidiary that is given to us in the what? In the financial statement. After which we are going to deduct any pre-acquisition retained earning NCI is actually the remaining share that's not acquired, the portion that is left after acquisition. The portion that is left after acquisition. That is simply what we called NCI. And the full meaning of NCI is really non-controlling interest. It's non-controlling interest. Having said that, we are going to deduct any unrealized profit from the subsidiary. That is peradventure if the subsidiary is actually the seller. If the parent is the seller, we are going to be adjusting for that under the parent consolidated retained earnings. It will not be here. Here is only for what? Subsidiary alone. Here is only for subsidiary alone. Please take note of that. After that, we shall be moving to subsidiaries net assets. We shall be moving to subsidiaries net assets. And the subsidiary net assets include DOC, DOA, and the post-acquisition. At the top of each, I actually put what DOC mean, what DOA mean, and how I will be getting my what? Post-acquisition. And how I'll be getting my what? Post-acquisition. All right. Every asset, the net asset of the subsidiary, as we said earlier, is really what we are acquiring. That is what we are acquiring. So in order to do that, we are going to be picking the share capital of the company. After the share capital of the company, then the share capital as a DOA, as a DOC. After which, we are now going to pick share premium, if any. If we have share premium, we are going to be adding the share premium to it. After which, we are going to be having retained earnings. This retained earning will now be as adjusted above, working 2. The retained earning would be as adjusted above, working 2. After that, if there's any revaluation surpluses, it's going to be here. Any fair value adjustment, we're also going to have it there. Likewise, if there's any depreciation of the fair value, it is going to be what? There. Please take note of that. Having said that, the next one is goodwill calculation. This is very germane. In most of the questions, they will only ask us to calculate the goodwill alone. And in some, they will be asking for how a group structure is being formed. Let's add our consideration transfer, which is the cost of investment. Then, it's either cash, share, deferred, contingent, whatsoever. Add NCI value at DOA, date of acquisition. It's either using the fair value or the proportionate of the share. Then, purchase consideration is what we are going to get after adding our NCI value to the what? Consideration transferred. Then we are going to deduct the subsidiary net asset at acquisition. Then we have our goodwill. calculation. If there's any impairment, we are going to be deducting it there. Then we will get our goodwill on consolidation. Same for NCI calculation. If the question asks us to determine NCI, we shall be having NCI value at DOA, then add NCI post-acquisition profit that we calculated in working note 3. Then we have to deduct NCI where the fair value, where it is fair value measured. If it is proportionate, it will not be there. Investment in associates. According to IS 28, it says equity method of accounting. Equity method is consideration transfer, add proportionate of association profit, which is post-acquisition profit. Then deduct any impairment from the associate, 100%. Then you get the total balance for your investment in associates. The last but not the least is consolidated retained earnings, which is the aggregate of the retained earnings of the parent. Parent retained earning, parent alone is retained earning in the SOFP. Then we add post-acquisition profit, less impairment, then any other adjustment that we have there, either addition or subtraction, then we are going to get the total. Having said that, the next to examine is actually our goodwill calculation. Are we there?
Yes.
How do we calculate goodwill? Goodwill is actually the excess of the amount transferred plus the amount of NCI over the fair value of the net asset of the subsidiary. Goodwill can be positive goodwill and it can be negative goodwill. Negative goodwill is also called gain on bargain purchase. Negative goodwill is also known as gain on bargain purchase. Negative goodwill is known as gain on bargain purchase. While positive goodwill is where the purchase consideration is greater than the net asset of the subsidiary at DOA. And the negative goodwill is where the purchase consideration is lower than the net asset of subsidiary at DOA. And this will be added to the retained of the parent company and will not reflect in the word consolidated statement of financial position. Goodwill measurement. To measure goodwill, you can really measure it in two ways. One, either partial goodwill, or we use what? Full goodwill method. Partial is also known as proportionate method, while full goodwill is also known as fair value method. Full goodwill is also known as fair value method. According to IFRS 3 as revised, it actually allowed either method to be used for acquisition. It allows any of the method to be used for what? Acquisition. However, the choice that we use is depend on transactional basis. We don't just assume. It is the transaction that is going to tell us whether it is fair value or it is partial goodwill method. From the question, we'll be seeing it where they'll be giving us, it is the company policy to measure this by this. The moment you are having, it is the company policy, let us know that that is what they are already calling for. Let's know that that is what they are already calling for. Hello? Are we together?
Yes, I can hear you.
So